Hey everybody, Marty Mazur, good afternoon, 2nd of April 2016. Okay, so in the charts today, I want to start with an I told you so. Then I want to dig a little deeper into why I've sounded a little bit pessimistic in the short term or skeptical that we're ready to go ahead and mount our way to all-time highs and substantially above those in the near term. So the I told you so is these circles, these bubbles. You may recall weeks ago, those of you who have been with me consistently on the charts, that these were yellow. And I told you I can virtually promise you that we will live long enough so that I would turn them green. And that would be when we come back and fill these gaps. Now, these gaps are when a day opened lower than the lowest point of the previous day. And when that happens and there's a noticeable gap, I put in a yellow bubble, 90% chance that those are going to get filled both to the upside and downside. Obviously, when they don't get filled, at least historically, or when they haven't, is when we've been on the very low end and the market never came back that low to fill those gaps. Could it, in a volatile environment, come back and turn that one green and that one? Of course, it could, but that remains to be seen. Then we have this upward sloping wedge pattern, which on a short-term basis is a bearish signal. We tend to break out below. Of course, nothing happens every time in the market, folks. That would make it way too easy. So could this be a time when it does something somewhat atypical and breaks to the upside? Absolutely, unequivocally, it could be one of those times. So let's look at the one-year chart. Very interesting chart. We are or have on Friday substantially broke through this downward sloping wedge, or I'm sorry, trend line that we've been looking at. And we actually broke through it on Wednesday, I think, didn't on Thursday, and then did noticeably on Friday. If we can stay above that for a few days, then this could easily become support. And there's some real daylight up to this potential resistance. We get much above there, and we are then at all-time highs. So this looks good. The 50-day moving average sloping up looks good. This 200-day flattening out looks good. This crosses above that. Technicians call that a golden cross. Often that's a good sign, although as you can see here, sometime, like all of these indicators, it does give a false signal. So with that and with a good-looking chart and a couple other things that I'll mention in a second, why would I be a little short-term bearish? Well, okay, so before I get there, let's talk about breadth. I've been talking about the fact that 90+% of the S&P 500 is trading above its 50-day, or they're trading above their 50-day moving average. It's very strong, very encouraging breadth. Earnings season is about to begin. It's going to be ugly, although the estimates are ugly. So it's probably going to be pretty easy for companies to beat earnings estimates. Question is how much of that is already expected. I think if earnings season is going to turn out to be positive for stocks, it's going to be because of improved outlooks. And I can make an argument based on the written blog that the dollar is trading lower, that if that continues, that could be something that inspires corporate executives to say good things about their forward prospects, particularly the multinational companies, because that's been what many of them have been reporting as a real headwind to earnings. And the dollar's been trading lower this year, as I illustrated for you. And so if they believe that that's going to be the trend this year and that the Fed's going to stay out of the way, we could get some real optimism going forward. And that could be good for the market. So that's an excuse to maybe get things going with some greater momentum to the upside and then finally getting above all-time highs, which becomes very bullish going forward. Okay, so why the skepticism? Well, a couple of things. I keep talking about volume. This is SPY, the ETF that tracks the S&P 500 index. Heavily traded, lots of volume. So here we are at a recent top on November 3rd. Here we are at the February 11th bottom, and here we are with this very impressive rally since then. Okay, so volume, folks, is the number of shares that trade hands on a daily basis. It's very important that if you want to substantiate or legitimize a trend, that it's confirmed by the volume, that it's higher as the trend gains momentum, or at least on a price basis. You want to see volume confirming that, and that suggests that maybe it's got staying power. And it is more important. Markets can fall just with inertia, but to go higher, you've got to see commitment if it's going to be sustainable. So let me pull up volume for SPY, and as you'll see, and I drew some lines here, from the peak to the trough, we saw upward sloping volume. This white line here is the 15-day moving average. You saw it begin to lose momentum as the correction lost momentum, but from start to finish, it was there was quite a bit of conviction. The rally, unfortunately, not so much. You can see that volume has steadily declined on average throughout the rally, and there's the 15-day moving average. Of course, that would confirm that, given what the bars look like. So that's not encouraging, folks. So that's a reason to be skeptical that this rally here may be reaching its peak, and maybe it needs a pullback before we then mount our attack at all-time highs. This does not have to come true. It doesn't have to mean that. I told you the other day that there's a tremendous amount of short interest in the market. The longer it stays up, if the shorts become believers and they have to cover, then you're going to see volume pick up in a big way, and then you're going to see some real momentum to the upside. Plus, there are some indications that the individual investor is coming back. If they really come back in a big way, then we could push up, in there easily. So I can make an argument in both directions. I just think there's probably reason to have a bias near term to the downside. Let me give you one more support of that. This chart shows the high yield HYG, which is an ETF that tracks a high yield debt index, and that's the white line, and TLT, which tracks 20-year treasuries. That's the green line. I mentioned this a few weeks ago as being very bullish. This looked like it had bottomed and had moved higher. That says good things about the economy, and that's a very good signal for the stock market. There's been a pretty close correlation between stocks and HYG this year, and I think energy has something to do with that. And the fact that this had been trading lower, that was a good sign. People were exiting high safe assets and buying risk. So that's the last 30 days. So that trend is still there on a short-term basis, and my skepticism is relatively short-term. Let's look at the 10-day. Oops, as you can see, HYG has broken down, even though stocks have continued to go up, and TLT has gone up. That's a very interesting sign. That's people buying safety and selling risk, because that would be a risk-off mode, despite the fact that stocks are going higher, but we can see that in the volume as well. So on a short-term basis, folks, just another reason to be skeptical. Does that mean that tomorrow this won't overtake this one and we have that trend resume that we've seen the last 30 days? Of course it doesn't mean that. That could very easily happen. Well, it would be tomorrow because tomorrow's Sunday, but next week. All this can change. But right now, with the evidence in front of me, if I were a short-term trader, I would be short-term bearish on the market. But when I look at breadth and I look at some of these other things beyond the very short term, I could make a pretty bullish argument. So whether I'm bullish or bearish on the short or intermediate term, does that mean that I would change my long-term strategy? That in my portfolio, in my funds, in my exchange-traded funds where I own Apple and Amazon and GE and Johnson & Johnson and a lot of great companies, would I allow this sort of data and this look at the market to change my perspective if I want to be like Warren Buffett and own good companies for the long term? Absolutely not. So why do I show this to you? Because there's a lot of noise out there. There's a lot of media that comes at you. One of the presidential candidates today said they're very bearish on the market and it's going to get real ugly. They have absolutely no basis for that. I'm basically giving you a very deep look at market dynamics and so on. All of it can change. Nobody knows for sure. These signals at times are very good signals. At times they're false signals. But at the end of the day, folks, you want to maintain the proper allocation relative to your age and your risk tolerance in the market. Own good stuff. Try not to time it. But understanding what pushes the market around in the near term, I think, makes us more comfortable with it. And that's my goal here. Thank you, as always, for watching and listening. And I will talk to you next week. Have a great rest of the weekend. Bye-bye.